Good afternoon, distinguished ladies and gentlemen. Welcome to the Climate Finance panel of this year's Africa CEO Forum. I head Africa Business Plus, which is the daily premium economic information service of the Jeune Afrique Media Group, the organizer of this beautiful forum, and it's my great pleasure to be your moderator today. So what is Africa's ability to sit at the table and play a key role in tomorrow's world economy, which is the theme of this year's Africa CEO Forum, while all along being challenged by climate change's even severe disruptions? Indeed, in today's session, we're going to examine how we can unlock climate finance, and particularly how the private and public sector can better collaborate together to that end. Private flows account for just 14% of funds devoted to African climate finance, which is already facing a 213 billion shortfall. But DFIs can play a crucial role in attracting more capital from the private sector. So now I'm going to hand over the mic to our expert from Boston Consulting Group, Kahir Danani, Managing Director and Partner, focusing on climate action. And he's going to give us a short presentation on the topic.
Thanks so much, Gael, and it's a real pleasure and privilege to be here. And thank you to Jeune Afrique for hosting this forum and for inviting me to share some thoughts with all of you. I'm hoping to start today at the global level and then zoom in on Africa in particular. And as we do that, make some suggestions for how we might unlock climate finance from the perspective of MDBs and IFIs. Done. Okay. Okay. Sorry about this. And here we are. Okay. So to begin with, I think it's important for us to acknowledge that the climate finance flows today are actually growing, and they have been growing for the last few years. So if you look at the last few years, the compound annual growth rate of climate finance has been about 27%, which is quite incredible, reaching about 1.4 trillion, depending on how you calculate it. The CPI calculated at 1.3 trillion. Most of that money is on mitigation, and so it's important to recognize that about 90% of that money is on mitigation, 10% on adaptation, and Africa really needs adaptation money. But on the right hand side, you see that 1.4 trillion, no matter what, is very far from the gap that we need. We need about 7.5 trillion annually to reach a world of 1.5 degrees. And that means that we have a 5 times increase in the amount of finance flowing that needs to happen. When you think about emerging markets and developing economies, that 5x increase actually grows to 10x. So we need to double the amount of financing going to emerging markets and 10 times the amount of money going to emerging markets and developing economies. And the reality is, as I said, is that much of what the emerging markets and developing economies need is adaptation finance, not mitigation finance. And so that's the biggest challenge that we see here. A lot of the discussion at the COPs, from COP26 to 27 and 28, Glasgow, Sharm el-Sheikh, and Dubai, has been around the 100 billion, which was promised in 2015. And I just want you to take a step back and think, like, does 100 billion even matter in these numbers, right? We're focusing, and the global debate, is really not on the right thing sometimes. And so I hope that in this current COP that we'll see in Baku, they really have a step change in what's called the collective goal should be. Looking at Africa in particular, only 2% of the climate finance flows globally come to Africa, and that's sub-Saharan Africa. Now, if you add North Africa, that's another 1%. But that's really nothing to think about. And of that, 2 to 3%, 10% is from the private sector. So the challenge is we have a huge gap and a huge amount of flows in climate finance globally. Coming to Africa, it's quite minimal. We're here to talk about IFIs and multilateral development banks. And if you look at where the multilateral development banks are playing, in terms of the total climate finance in 22, 10% of that came from the MDBs, right? That's not a large number, but it is a significant number. When you think about adaptation finance, and this is the good news, the amount of money coming from the multilateral development banks is 44%. And that shouldn't be surprising because multilateral development banks care about development and adaptation and resilience are very closely intertwined. So you have a lot of activity in that area. So it's important to start from that point that the MDBs are doing a fair share of financing of adaptation finance. The thing that you should note on this chart is that the private sector is absolutely negligible, right? So the amount of money that needs to come from the private sector is a huge gap, and that's where the money will really show up for this for the climate transition that we have forward. And if you look at this and you think about it, this is an illustrative chart, but the public money has to come in to de-risk the private money, right? And that's what we're seeing, like that catalytic potential of the money that is in the public sector from the MDBs, from the DFIs. To catalyze private finance, and that should make, and that is intended to make, the big difference for financial flows coming to Africa. And Makhtar actually talked a little bit about this in the morning, if you were there. The good thing is that the MDBs do agree about this, and so they've come together and said we want to make a difference, and we want to look at how we can make a difference collectively on this issue. The big challenge, though, and I would say there are 5 challenges from our perspective around why that private capital isn't flowing. And these frictions are really important. The first is the perceived lack of bankable projects and project risks in Africa. And I would say that these are around construction risk, offtake risk, management risks, and that makes the investors feel that these projects are unbankable. However, those types of risks are present whether we're in Rwanda or we're in Germany or in Japan or in Brazil. So we need to be conscious that project-related risks are not idiosyncratic to Africa. The second point is really important, the country risk profiles, because adding fuel to the fire in Africa is this challenge of macro-fiscal and political risk. We talked a little bit about this in the opening plenary today. We've done some analysis that looks at countries that have the similar ratings as African countries around the world and similar projects. And we find that in Africa, for a same project with the same country risk rating, you're paying 500 basis points more than a project in other parts of the world. So for example, in Brazil, with Brazil versus South Africa, same project, same country risk rating, same offtake risks, etc. But the price of capital in Africa is 500 basis points higher. That's the second point. The third point is around the limited availability of concessionality. Even though all the MDBs combined together put out about 300 billion of capital in development and climate finance, only about 100 of that, or less than 100 of that, is related to climate, and it's all about how you account for it. But that means that the availability of concessional capital to be catalytic is not as present as it should be. Fourth is around harmonization within and across the MDBs and the DFIs. What I mean by this is that MDBs and DFIs are by definition bringing concessional capital. But what we see in the market is that they compete with each other. And when you're bringing already to some extent subsidized public money to investments in a given geography, should we have more competition? Competition is good. But in this particular scenario, we should be thinking critically about collaboration across the MDBs because what they're bringing is already very competitive compared to the private sector. And then finally, the data gaps, the disclosure requirements, and the taxonomies need to be worked on, and we need to sort of address those, and that will sort of help us with driving the agenda forward. So what can the MDBs do? We posit there's 4 big areas that they can focus on, right? They can provide catalytic finance that can help to mitigate the risks and create instruments that allow these projects to happen and make them more appealing. They can offer market intelligence and advisory services, which are crucial to understanding the complex dynamics at play in Africa. And this is even not just to projects, but also to the rating agencies, for example. They can deploy their own expertise, their own relationships and resources in things like project preparation facilities, to structure initiatives and that attract private capital and mobilize more private money. And finally, they can invest in capacity building both at the project level among financial institutions in Africa, but also financial institutions in other parts of the world, to make them understand that there really isn't, in all cases, that level of risk premium required. So those are the thoughts that I wanted to start us off with and help you with this discussion. We thought about a few questions for discussion, but I'm going to leave it to Gael to sort of share with you and to drive that discussion forward. Thank you very much for the opportunity here, and I'll leave it to the panel.
Please give Kay a big round of applause. Thank you. So now I'm going to be calling our 5 distinguished panelists. Françoise Lombard, she's CEO of Proparco. Please give her a round of applause. Okay, we also have the immense pleasure of welcoming Maria Atkinson, CEO of Swedfund. And Yvonne Ike, from Managing Director and Head of Sub-Saharan Africa. Managing Director and Head of Sub-Saharan Africa and Bank of America. Vivienne Yeda, Director General at East Africa Development Bank. And last but not least, Paul Russo, who is Group CEO at the Kenya Commercial Bank Group. Please give him a big round of applause. So, during his presentation, Kay outlined the 3 main questions we'll be addressing today during our conversation. And the first one is, what must the public sector and more specifically the DFIs do in order to better mobilize private capital for climate finance? That's our first key topic today. Second topic is, how can bankability of climate projects be indeed improved? And the third topic we'll be addressing today is, how can collaboration between DFIs, but also with commercial banks, be improved as well? So now I'm going to start with I'm going to sit here. So, Yvonne, I'm actually going to start with you and the commercial bank's perspective. Can you tell us about, there's an ambitious program to galvanize the private international sector at Bank of America.
Thank you very much, Gael. It's great to be here this afternoon. We've heard the challenges about NDBs just not having enough money to meet the need, the gap. We also know the opportunity. By 2075, the African economy could be a $44 trillion economy. Mm-hmm. So there's a huge gap to fill. There's a lot of work to do. And the good news is, in my entire career, I have never seen as much interest from the international community as we're seeing today, specifically countries like the US. So China has always engaged quite a lot. Even they're readdressing how they're engaging. But I'm seeing more interest from the US, from the Gulf states, and from Europe. And also from Global South, dealing more with Global South. Now, from a private sector perspective, what is really important is we need to focus on scale. Mm-hmm. We need to think about the tools that we're going to use to accelerate investment into the region, and we must collaborate. And so at Bank of America, we have an ambition to galvanize $1.5 trillion of capital for sustainable and climate transactions by 2030. So far, we've gotten to 400 billion. A small fraction of that is in Africa. is for Africa. So we need to continue to accelerate that. We have other initiatives of other innovations that we're doing around working with institutions, MDBs, and international private capital institutions to bring more product and access to more capital into the region. I'd like to use an example of Calvert Funds. It's a US-based fund. They have an amazing structure where they can take $20 from an investor or $20 million and everything in between into a vehicle. They take it onto their balance sheet. BofA are one of the people that are funding the debt on that. It's a debt instrument. And then they allocate that debt capital into funds across the world, including sub-Saharan Africa. And to date, it's a pilot that we were testing. To date, we have about $30 million in that pilot, but we're very excited about it, and we think it's something that can be replicated globally and replicated by many other funds. So that's one way where we need to continue expanding the pipe of investment coming into the region. Another important way is actually the types of instruments that we use. We need to mainstream the sources of capital that come into the region. And so what we're seeing more is we're doing a lot of work with the impact investors, the foundations, and also other government institutions that want to invest in Africa. So including institutions like DFC, for example, that want to invest in Africa, but the tools are not there, and they're not as many tools, and they're not as big. I'll come back to DFC later on as an example. But what we're finding is the collaboration with blended finance, where a number of parties are coming in, actually is working very well in increasing the scale and the sustainability of capital coming into the region. So there's good progress, but there's a lot more to do.
Okay, great introduction. Thank you, Yvonne. Paul, can you give us the African Commercial Bank's perspective and tell us about Kenya Commercial? How are you better mobilizing private capital for climate finance?
Yeah, thank you. I think in the first instance, just to say, KCB operates in 7 countries in Africa, particularly in Eastern Africa. 128 years old, so you're teaching a 128 years old organization to lend into climate finance, but certainly know something about banking. Just to give a bit of brief and background, so the first thing we decided to do first was to screen our loan book,
right,
just to make sure that that whole portfolio, we start greening it. We've screened 500 billion of our loan book. We have, we are the only ones, approved by GCF for Greenland.
Mm-hmm.
We are just about to close a $200 million facility to be able to pass on to businesses that are interested. Most importantly, I think just to give a feel, and sorry, I'm going to use Kenya shillings here, around a 25 billion Kenya shillings single borrower limit for purpose of lending to green finance. We signed off to net zero. We are signatories to the principles of responsible banking. But to come specifically directly to your question, I personally believe that no single institution, particularly banks in this side, that are going to be winning on their own. And we have to build on partnerships. And I'm a strong advocate of partnerships. FDB is one of those entities that we work with. We signed today a $95 million with Propaco to that extent. BII, DFC is interesting. We are closing out something with DFC. And so I am a firm believer on partnerships and bringing in, and I think the colleague that presented on BCG talked about something. How do you bring your expertise to the table and bring in partners who have ability to then facilitate that? Certainly, there are banks and institutions that have better experience outside of Africa or Eastern Africa. Mm-hmm. We bring in expertise on this other front. So I argue for partnership.
Okay, and that's certainly a theme we'll be talking a bit more later in our third key point. But now I'm going to turn to Vivienne. At East Africa Development Bank, you're at the very forefront of bearing the consequences of climate changes. Your client experience droughts, floods, deforestation in the region, and when we prepared this talk, you said you can't manage adaptation all alone. So tell us about EADB's journey, its journey into coping with climate finance, and tell us.
Thank you very much, and thank you for the opportunity to be here. I think as the East African Development Bank and an institution that is actually involved in supporting micro and small enterprises, those that are particularly not of interest to the larger DFIs and maybe even the commercial banks. So we actually support institutions that would not otherwise be funded. And these obviously are small enterprises who undertake their activities largely in the agricultural sector, relying on the natural cycle, natural rain and sun cycles. So in the last 10 years or so, obviously that has been there's been a significant change with weather patterns which affect rainfall and have a direct impact on our clients, and which also has a direct impact on our loan book. So, and we have undertaken this journey with them because we do understand why they're facing those challenges. So it's actually a very, very good news to our ears that climate finance and climate mitigation adaptation are now topical issues. They weren't topical issues 10 or 15 years ago when we started. We used to discuss these things and try to make a point in forums like this or in places where there were policymakers, but it was just not an exciting topic to have on the agenda. But now everybody's talking about it, so we do hope that something will get done. In our neck of the woods, I can hear the numbers being talked about. My colleague is throwing around big numbers. We haven't seen that money, particularly in the private sector, for adaptation. There's money coming in, and a lot of it has gone to mitigation and has gone to particular sectors of interest to the private sector and their bottom line. And that's the energy sector. So there's a lot of funding going to IPPs that are working in the green space, in geothermal, in hydro and the like, and wind. But this has a private sector profit motive, not really a motive that is tied to climate. What we are looking for is actually funding that goes to climate as a social good, as a public good for humanity. How can we, one, stop activities that are actually depleting the ecological cycle of the planet? And two, how can we rehabilitate at scale those natural resources that actually make our planet livable? So how do we rehabilitate our forests that have been decimated? And those forests are decimated because we are busy logging, cutting down trees to sell to the private sector. And so we want to ask the private sector, can you find an alternative solution other than using wood, and particularly wood from Africa, which is indigenous, and this comes from trees that are hundreds of years old. Instead of giving us money, because we are probably sure that will not be coming, can these kind of negative activities be stopped? And that would have an immediate and direct impact on the climate and also on rehabilitating the resources that are being currently depleted. We are very conscious of the fact that any sort of support we'll get from the private sector, unless I'm going to learn something new here, will be tied to the bottom line. So we have to develop projects that at the end of the day put a profit in the pocket of the private sector before they put in money. And those are not very easy to do when you're dealing with natural resources and the natural environment. We're dealing with wildlife, you're dealing with water courses. It's not easy to translate a project like that into a nice, neat return in the pocket. So that's the kind of discussion we are having, and those are the kind of challenges we are facing.
Okay, so mitigation and adaptation. So now I'm going to turn to the public sector. Françoise, what is Proparco's strategy regarding private capital mobilization for climate finance?
Thank you. So, just to start, I wanted to say that development finance institutions are contributing more and more to finance climate finance, of course. I mean, as climate has been a priority for all of us for quite a number of years now. For instance, at Proparco, not only 100% of our projects are aligned with the Paris Agreement, but more than 40% of our activity last year was directed towards projects with climate co-benefits, be it adaptation or mitigation. Having said that, of course, this is not enough to address the daunting shortfall of funding that has been mentioned at the beginning of the presentation. So we clearly have to do more or to be differently, because our own capital is not unlimited as well. So we have to do that differently. And this is a bit new for development finance institutions. In that sense that we were used to report on the volume of private capital we are mobilizing, but we were not so much used to have an objective of private capital mobilization as high on our agenda as, for instance, the volume of activity on our own balance sheet. So in that sense, it's a new paradigm for development finance institution. At Proparco, starting next year, we will have an objective to mobilize €1 of private capital for €1 on our own balance sheet. I think this is a target that is high enough to be sufficiently incentivizing internally, but it is also low enough to be credible. Because sometimes we are talking about leverage I don't believe in, clearly. And why this has to be credible? Because development finance institutions have also to keep on doing what they are doing, for instance, in fragile contexts. And let's be clear that we won't mobilize huge amounts of private capital in those contexts. So maybe one obvious point worth being shared here to start the discussion as well is that institutional investors, when they are setting up their investment strategy, they will look at the regulatory frameworks, they will take into account the nature of underlying assets, and so they will target mostly fixed income and hard currency denominated assets. And in that context, that's why so little money is going to Africa. So what can we do differently to improve that situation? The current conversation about private capital mobilization revolves a lot around blended finance and around, de-risked vehicles. I mean, credit-enhanced vehicles where DFIs are carrying a higher level of risk compared to other private investors, institutional investors. So I think it's clearly useful to attract institutional investors. And DFIs are working a lot on those new innovative schemes. For instance, many DFIs are working on the Global Green Bond Initiative from the European Commission. This is a European initiative that consists in a de-risked fund by the European Commission, and that de-risked fund will buy a portion of green bonds issued by sovereigns, sub-sovereigns, or even private issuers. and so hence sending a strong signal to private investors to attract them to buy another portion of those green bonds, because they will have confidence in the robustness of the assets of the project, and also on the quality of the green bond frameworks. So those innovative schemes are clearly useful. However, I think 2 points on the however. First one is that the OECD regulatory framework is not always conducive for DFIs, regulated DFIs, to do that. And so it is also costly on a capital point of view for DFIs to do that. And second point is that, and it's a consequence of the first one, those structures often requires concessional funds, because to make them compatible with our own risk appetite, and so it is costly. Because those concessional funds are limited by nature. So it is really useful. We have to work more on that kind of structures to leverage more, but we have also to, the discussion should not be narrowed to that blended finance structures. Today, we have also many private co-financiers that are willing to take exposure in non-OECD countries on climate assets, and on a pari passu basis with development finance institutions. For instance, insurers are more and more likely to work with DFIs. I'm talking about private credit insurance, willing to collaborate with DFIs because they get comfort in our processes, due diligences, so they value our expertise. And today, I think that private credit insurance is the largest pocket of private capital to be mobilized by DFIs through syndication schemes. My last point would be about the need for unlocking local financial systems to crowding domestic private capital, often best suited to finance local projects and local currency projects. So African banks have clearly a key role to play in that sense, by anticipating the risks, physical risks, by anticipating transition risks to avoid the depreciation of the assets, by also, helping transitioning of the economic players, and also divesting sometimes from high-intensive carbon sectors.
Okay, thank you. And we'll talk more about de-risking later. We're just running a bit late on our schedule, so I'm going to ask you now to all keep it to 2 minutes answer. Maria, what is Swedfond's perspective on private capital mobilization?
No, but being a DFI, I agree very much with what Francois said. I mean, for us, of course, it's at the heart of what we do to invest in climate, and also a part of our strategy to continue to increase our capability to actually mobilize capital. And I think, of course, just was illustrated in the introduction, it starts with what we invest in. And I think it's important, I mean, from our perspective, we have, like everyone else, started very much to invest in mitigation broadly across the energy transition. Now moving more into infrastructure in general, see how we can work with that from a decarbonization point of view. But then I think the issue of mitigation finance is also, or adaptation finance is also extremely important. And there we as DFIs have a very important role to play. And I think creating more bankable projects, using guarantees and other facility schemes to really de-risk kind of projects so that they over time become bankable. And I think one reflection from my perspective when it comes to adaptation finance is that it actually touches, like you said, Yvonne, on all sectors. So it is not something that maybe has to be so scary. I mean, it's really business models that are close to what the private sector does. I think we have to look upon adaptation finance from that perspective because we invest in a lot of different sectors. From Swedfond's perspective, I mean, just like Proparco, we also have targets on how to mobilize. We have a generous owner, so we are fully equity financed, and we get annual capital injections targeted for climate, making it possible for us to take risk. We have TA funding, and we also have guarantees. historically, we have been mobilizing very much on an individual investment level, working with co-financers that are willing, just like Francois said, to go in on an individual investment. But I think what is important, we talk a lot about the access to finance, the need for concessional finance, of course. But I think it's important to remember that as a DFI, we come in with capital that is commercially directed. So we should not compete, but we should not subsidize also the private sector. But it really needs to be a way to be catalytic and build that bridge. And I think that's important to keep in mind when we talk about us public finance, that it has to be for financial viable. I think that is extremely important. And then I think the work that we do around ESG, that really puts a quality stamp around a lot of different assets, and that's also important to bring forward. Then it will be, as has been said, it's not enough what has to be done so far, so there is a big need to create different kind of structures where we can really do it at a different scale. Where I think the diversification is an extremely important part, taking also the country risk discussion in the beginning into consideration, and really pooling different kinds of capital. Then I don't think there is a silver bullet, but I think really all the joint efforts that everyone does, trying out different things and learn from that, that's kind of how we move the needle forward.
Okay, great.
Can I maybe, on your left, I'll keep it very short. But I was on the board, so as many might have seen, it's not that I didn't show up. My name is Michael Jongeneel. I'm the CEO of FMO, the Dutch Development Bank. So I'll keep it very short.
I'm sorry, we'll be taking questions from the floor a bit later on.
I'm just excusing myself. I'm here. It's not that I didn't show up. Go ahead.
Okay, I'm sorry, okay. Okay. So, Maria, you talked about how projects have to be bankable. And so this is going to be our second big question today. How can we increase the inherent bankability of climate projects? And I'm going to start again with commercial banks. Yvonne, tell us how climate projects move from credible to bankable status.
Yeah, thank you. Thank you, Gael, for making
it short, because we're running late. Sorry.
Thank you for making the distinction between credible and bankable, because there are a lot of credible projects in Africa, especially if we look in some of the adaptation and mitigation spaces, especially around energy. So the difference really is, and I think the big delta is really around the fact that a lot of the projects that we need today in Africa to meet the solutions that we have been untested anywhere in the world, particularly in Africa. So what we do need is more project development finance, and that...
I think you're good.
Can you hear me?
Yeah.
Okay.
Yeah.
So what we do need is more project development finance. I do think this funding should be centralized with the African commercial and development agencies. They understand the risk. They know how to do it. The question then, and they know how, and they will better manage the deployment of it. And so what we tend to see is the lack of centralization is causing inefficiencies. Now, the question would then be, where do we fund that from? I want to suggest that some of the pledges and grants that are being offered to Africa are centralized into institutions that can support project development. And I think this would make a big difference in terms of how we manage the risk. And there are also structures that help stage out the projects more carefully, so that along the way you advance, so that you can see where the risks are and then continue as you go along. So milestone financing is one typical type of financing that would work better to help projects become more proven to be viable. We do need concessional financing and some grant financing mixed with commercial financing for this. It's very important.
Okay, thank you. Paul, what can you add to that?
I would say a number of pillars, right? I think first, I believe and I agree that there are bankable projects in Africa. And it goes back to the presentation that we had earlier on. We just need to deal with the risk management component of it. I'll list out the top of mind a few of those. One, and we've attempted to use that very well this side of the world, is syndication. Is bringing a number of entities together, spread the risk, and you know, as they say, if it doesn't work, then we all feel the pain, but one party doesn't take the pain. Seems casual, but you must look for solution that works to great. You believe in the project, you want to fund it, but your risk appetite is not to the full value. You bring in other parties and you work together. I think, you know, the mention of structures and how we structure, that is why, for example, KCB has set up an investment bank on its own, skilled resources that are able to create structuring for the rest of the bank. That skill is not available in the bank, but it sits in an investment bank and is available across the group to be able to do that. We need to invest in those skills. Those who know, they are pricey, they are in high demand, and therefore we need to continue to invest in skills and competencies that are able to support the side of the bank. Quickly, and I know we're pressed on time, is there has to be ways for us to be able to cover, you know, upfront costs. These projects require spending before you see anything. And I think there must be ways to try, either by governments, and I sit in a committee that looks at some of the investments post COP28, specifically for Kenya. And in a number of instances, we're asking government to come in to clear some of those costs to facilitate the party to come in. Think about simple things. Again, land is emotive, land is limited. Governments need to come in to support in that front. It's initial capital, it's expensive to be able to spend on. There are ways to be able to just think about, many of you will know Lake Turkana wind power in Kenya. That huge land today is still in court on because of community demanding that particular land. If you don't structure conversations around land, and yet it's the largest wind power generation, but it's successful, but it's dogged with community issues and you're spending time in court. So we've got to be able to try and do that and facilitate for government. I think there has to be partners that come in and say, how do we champion fast movers in some places? So some of these things have not been done, but how do we champion? So I think about, you know, generating power in some local places in some of these countries. If somebody tells you we want to go and generate power from a certain river, see, I used to swim in that river and that point. I just can't believe that there will be power that will come in from there. How do you fund champions? And finally, I think it was mentioned, how do we pool expertise? I could be a bank. I could be looking to fund. Propaco has better expertise somewhere, and how do we come together and how can I get, whether it's a form of a grant, human capital to come in and support. And we are transparent in these transactions rather than compete. Yeah, so that's what would be top of mind for me.
And do you have institutional investors, local investors, pension funds, maybe coming into those long-term infrastructure projects?
I think it is what Vivian said. You know, most shareholders, most pension funds and the pensioners are looking for a specific return. In fact, they sent, in their policies, they set a specific return to the fund managers and investors and in their investment policy. So there's a bit of work to be done on that. And that's why I said, and I think Vivian said, there's funding. But there are constraints on returns and demands on this other front. I'm on record, we didn't pay dividends for 2023 performance. It wasn't that we couldn't afford, we wanted to plow it back. But retail investors wanted to massacre me and kill before that because for the last 21 years, they were receiving dividends and they expect a certain return. And therefore, as Vivian says, you'll be forced to swing to what is going to give you a higher return to be able to meet that expectation. So where is that patient capital? And where is that link where we can bring in partners and be able to yet still make money, meaningful returns? But I guess bankers in the room should be aware we're in a space where margins are going to be compressed. You better look for volumes. and more sustainable projects. You can see that in non-performing loans. You go for high interest rates, you're burning it downstream. So time to adjust, and I think there was a point about mindset that we just need to change.
Okay. We're very much behind schedule, but I think it's a fascinating conversation, institutional investors and pension funds. Okay, Françoise, according to Proparco, very quickly, what measures are needed to co-develop bankable projects in climate finance?
Thank you. So first project preparation is really crucial. We need more project preparation funding to have more bankable projects. I mean, projects meeting the criteria of asset owners in terms of liquidity, size, currency, etc. So this is a really relevant use of concessional funds. This is not always obvious because for, it's grant-based mostly, and so for donors, you don't know in advance what you will fund, and so sometimes it's less attractive, but it is really, really crucial. Second, we have, of course, developed TA. We have partnering for quite a number of years with local banks, African banks, providing climate credit lines to those banks, where the use of fund is earmarked, is directed to projects with climate co-benefits. And alongside those credit lines, of course, most of the time we are providing some TA, technical assistance, for instance, to help the bank identifying processes to identify climate opportunities, or to set up frameworks, and also to have tools to measure GHG emissions. So, for instance, and of course, I think this is crucial to mainstream those technical assistance tools. But what we have done recently, just to be short on that, is a kind of different approach. I mean, it's a kind of approach which we call pro-climate approach. So we will not only look at the use of funds, but rather on our partner to mainstream climate through its strategy, the decision-making processes, or also operations. So I think it's really interesting because it will focus on the actor and not only on the use of funds, and it is quite powerful, I think, to help transitioning this kind of economic players.
Okay, Maria, even shorter question. What's Swedfund's perspective on bankability?
No, but I think, of course, it's important to understand why they are not bankable. So, of course, it's the need of financing, concessional financing, TA funding, and from our perspective, both to develop the companies that we invest in so that they, over time, become bankable by the private sector. And then we also have a TA facility that we can utilize actually to finance the development of more projects even before we invest ourselves. I think it's important to work in general with how the different investees, just like François said, how they work with climate, how they mainstream it, how they manage, and how they can really illustrate that they are climate investments. But then I think we have, as a DFI, have other important roles to play as well. I think if we're going to solve the issue coming back to adaptation, I think it's extremely important that we dare to try out new business models. So we have done a fairly recent investment into the agriculture sector, where you really combine financing, microfinancing, you can say, but also with the access to seeds and to fertilizers, and with insurance and with advisory. So you kind of package things in a different way. This business model is not cash flow positive yet, but I think that's also an important role for us to really use, as I said then, guarantees to de-risk these projects. And I think more importantly, actually to prove that there are new business models. And I think that's really what the DFI also can do. Then I think there's another perspective. I mean, we are, from a DFI perspective, we are willing to go in early in the life cycle in general, and at the same time, we are also fairly long-term investors. I think we also need to think through, talking about creating bankable projects, if we should package and sell off at some point in time in the life cycle, and by that free up money so we can kind of start off earlier in the life cycle, and by that actually having more mature asset that we sell off to institutional owners. That could also be one way to utilizing our role, both to find new structures for mobilizing, but also more bankable projects.
Thank you. Vivienne, you talked earlier about the importance of bottom line. Can you tell us about how bankable mitigation projects have direct impact on those bottom lines?
Thank you. I think from where we sit, as I said, we are really at the heart of the problem, and we're having to deal with the clients in real time. So sort of long-winded conversations and promises to do don't help. We need to act here and now. So we've just gone through a flood season. If a client has lost all their livestock because there was global warming, which they did not contribute to, how are we going to help them to replenish their stock so that they can earn their livelihood next year? Otherwise, this year they are destitute. So as a DFI, those are the kind of challenges that we are grappling with, and probably we've extended a facility which now will not be repaid. It becomes an immediate loss to us, but we understand why. It's not because of a shortfall on the implementation capability of the client. So what we'd like to have are discussions around for climate and climate-related projects, and particularly for vulnerable communities. What is a bankable project? I don't think we can take the metrics that we would use for an oil and gas or an energy project and foist it on a climate initiative and expect to get similar returns. So from where we sit, we need to redesign the metrics. The returns may not be on the bottom line or immediately on the bottom line, but the returns will be longer term. And are we willing to wait for that long term? And then we also need to scale, because if we are rehabilitating a forest in Uganda, it's a very positive thing. And will support the local economy and the local communities, but we need to rehabilitate forests everywhere for there to be a collective impact globally. So the solutions have to be local, have to be global. And how do we partner together as DFIs and as communities and as commercial institutions to actually make this happen? Because the way we see it, this is an existential threat. It's not about something that might happen or is a theory. And if it does happen, the way we understand it happens globally. We may be the first, but eventually it will cascade. So what we'd like to understand and what we'd like to participate in is a very real practical conversation of how do we go from here to the next level as financial institutions, as DFIs, so that we have a collective and meaningful impact globally. When I hear bankable, I also hear debt. And Africa, East Africa are the regions of the world that are affected. Now, there will be debt accruing to an institution or to a government on adaptation, not something that they had envisaged. How do we share that cost? Because it's not realistic to expect some of our communities or our governments to actually bear the cost. And since this is an international and a global problem, it would be interesting to see how we can spread the cost across, so that it's actually, one, we are able to implement the project because it's viable, but it's affordable, and the cost of it does not impede its implementation. So those are some of the issues that we are grappling with, and would really like to collaborate with others to see how we can address them.
Okay, thank you. Okay, we've literally got 3 minutes left for our last topic, which is collaboration. But the good news is that we've already touched upon collaboration. So I'm going to ask each of you to add a final contribution on that key point, and I'm going to start with you, Françoise. Maria, if you can, yeah, next.
Thank you. As a final word, I would insist on the need for yes, acting, operating differently. I mean, we completely agree on that. Scaling our action in favor of climate is really crucial. And so new tools like the risk structures, etc., are clearly relevant in that direction. And DFIs have to be more and more catalysts. But we have to put it in a broader perspective, and I mean, this is not always a question of tools or incentives. It is also a question of conditions conducive for private sector involvement, an enabling environment, a robust local financial system, a good regulatory framework, etc. So let's have in mind this, I mean, new ways of acting in favor of climate finance are really relevant, but the solutions are clearly broader than that.
Okay, Maria, very quickly, how do you echo that?
No, but I agree with what Francois said, and as I said in the beginning, I don't think there is a silver bullet, but I think it's extremely important that we try out different structures and play on the basis of the different roles that we have. And I think from our perspective, it really comes down to what we invest in. If you look on the charts in the beginning, it's very much what the DFIs and the MDBs invest in. That is what becomes what you can mobilize on. And I think we have a very big responsibility there, both in the continue to invest in mitigation, but also find new ways to invest in adaptation and really look upon that as a way to explore new business models. I think that's very important.
Okay, Vivienne. Yvonne, okay, let's do this. Yvonne?
The key challenge we have is scale. To scale up what everybody is doing today. One of the most important ingredients for that is collaborating on insurance, political and credit risk insurance. We're seeing a lot more instances now where institutional DFI, international DFIs, local DFIs, and private capital are coming together to provide insurance solutions on scale for important projects. We need to accelerate that. The other thing that we need to do as a matter of great urgency is continue to think about how we manage the debt stock that we have in Africa out of debt and into other instruments. So, for example, the debt for nature swap that we did with Gabon is a classic example where DFC worked with nature conservation and Bank of America to create a solution that would not have been available to Gabon. Now we're in discussions with AFDB and other institutions. The net is broadening in terms of people coming to the table to find creative ways to reduce the debt stock and swap it out into cheaper debt for the countries. And it's now debt not just for nature, but debt for impact. And so these are very, very important initiatives that we must really focus on. I have to stress, we've seen the numbers. MDBs and DFIs alone are contributing 10% to what we have. There's $1 trillion of climate finance that's been pledged / dispersed so far. A tiny fraction of it has gone to Africa. For us to get that up, we must work more with the African MDBs, the African commercial banks. They understand the risk better. They're well positioned to help manage it. And that part of the collaboration is very important to scale up growth at this time.
Okay, thank you. Vivienne?
I think for me, what we need to agree that adaptation and the actions and activities around it are not discretionary, because as we are told by the scientists, time is against us. And I think this is the time for governments to do what they do, which is create enabling environments which may not be very popular, including tax incentives and the like, to encourage, let me say, the private sector to actually participate in this very, very essential task of climate adaptation. Because I believe without a clear incentive within a regulated framework, it becomes a discretionary and voluntary exercise. And that will lead to fragmentation. We don't have the scale. But we need to agree globally that this is the direction of travel, and then all of us, should adhere to it. As DFIs, of course, the duty is also upon us to cooperate with each other and leverage on each other's skills in order to create, the necessary scale, in order to make a difference.
Okay.
Thank you.
Thank you, Vivienne. Paul, you have the last word on collaboration.
I think the only thing I would say is we need to find ways of working in such a way that stakeholders mapping happens upfront and that there is involvement even before you come in to ask for funding. I think we try and do so many things before you loop in many stakeholders, and that actually has a knock-on effect on whether these projects succeed. So early enough stakeholder mapping and engagement will really, help.
Okay. Well, time flies. So this topic is immensely complex. Talk about de-risking, talk about collaboration, we talk about bankability, we talk about better mobilizing the private sector. Please thank our panelists for this beautiful conversation. Give them a big round of applause. And I'm sorry we didn't have time to take questions from the floor, but perhaps we can continue this conversation going out and networking with the participants of this forum. Thank you.